Most traders spend years chasing indicators: RSI, MACD, Bollinger Bands, 12 different moving averages stacked on one chart, and yet one of the most powerful edges in the markets has been hiding in plain sight for nearly a century, printed on every wall calendar in the world. Today we're going to talk about seasonality, what it actually is, why it works, how professionals use it to make money, and finally the exact numbers behind the strongest seasonal patterns on the S&P 500. Let's go. Let's start with the foundation. Seasonality is the tendency of a market to behave in a recurring, time-based pattern that repeats year after year, independent of the underlying trend. Originally, the word comes from agriculture. Wheat goes up before harvest. Oil goes up before winter. Gasoline goes up before summer driving season. These patterns are not random. They're driven by predictable, calendar-based shifts in supply and demand. But here's the key insight that most retail traders miss. Financial markets have their own version of seasons. Not weather seasons, but flow seasons. Money moves through the system on a schedule. Tax deadlines, earnings cycles, pension contributions, bonus payments, fiscal year ends, government spending cycles. Every one of those creates a recurring footprint in price. And once you learn to see the calendar as a map of capital flow rather than just dates, you start trading with the river instead of against it. So why does this pattern keep repeating? And why don't traders just figure it out and cancel it out? The answer is simple. A huge amount of money in markets does not move because someone wants it to. It moves because someone has to move it. Think of it this way. Markets are not just traders making bets. There are also millions of automatic scheduled money transfers happening in the background. Let me give you 4 examples. 1. Retirement and pension funds. Every paycheck, money flows into pension plans. By law, those funds have to invest that money on a fixed schedule, regardless of what the market is doing. 2. Taxes. In the US, people sell losing investments in October and November to lower their tax bill. Then in January, fresh money comes back into the market once tax season pressure is gone. 3. Earnings reports. Public companies report their results 4 times a year, on the same weeks every year. That creates predictable waves of attention and money flow around those dates. 4. Vacations. Yeah, really. In summer, professional traders take time off. Trading volume drops, markets get quieter. This happens every single year. Add it all up. A lot of money in the market moves on a calendar, not on a feeling, and calendars don't change. That's why the pattern survives. Okay, theory is clear, but how does a regular person actually use this? There are 3 simple ways. No shorting, no options, no complicated math. Method 1. Only be in the market during the strong months. The simplest rule in trading history goes like this. Sell in May and go away. You buy the S&P 500 in early November, sell at the end of April, and sit in cash for other 6 months. Sounds too basic to work? Over the last 7 years, this strategy has delivered almost the same returns as buying and holding forever, except you were only in the market half the time. That means less stress, smaller drawdowns, and a lot fewer sleepless nights during crashes like 2008 and 2020. Method 2. Follow the season. Different sectors have different strong months. Retail stocks tend to climb before Black Friday and Christmas. Tech runs hot from October into January earnings. Energy often leads in the spring. The idea is simple. Instead of holding everything all the time, rotate into whichever sector is entering its strong season. Method 3. Use the calendar as a filter. This is the most important point for beginners. You don't need to make seasonality your entire strategy. Just use it as a hint. In strong months, be more aggressive, buy more often. In weak months, play it safe, hold less. Don't be a hero. The calendar doesn't tell you what to buy. It tells you when it makes sense to be active and when it's smarter to sit on your hands. The main takeaway: professionals never use seasonality on its own. It's not a magic button. It's a tailwind. The wind alone won't get you anywhere, but if you're sailing in its direction, reaching your destination becomes a whole lot easier. Here's why seasonality deserves a permanent spot on your dashboard, even if you're a pure technical trader. It's leading, not lagging. Every momentum indicator, RSI, MACD, moving averages, is mathematically derived from past price. They tell you what already happened. Seasonality tells you what's statistically likely to happen next, before price gives any signal. It can't be over-optimized. You can't curve fit the calendar. November is November, the data is the data. It works across asset classes: stocks, bonds, currencies, commodities, even crypto. Every market with structural flows has seasonality. It compounds with other tools. Stack it with trend, and you've got asymmetric edge. Stack it with momentum, and you've got conviction. And this is huge, it tells you when not to trade. Half the value of seasonality is not the strong months. It's the warning signal during weak months that keeps you small or in cash. Okay, theory's locked in, now the numbers. Let's start with the wildest stat in modern markets. Overnight versus intraday. Since 1993, virtually all of the S&P 500's long-term return has happened overnight, between the closing bell and the next morning's open. The intraday session, open to close, has produced essentially zero cumulative return over 30 years. Why? Earnings drop after hours. Macro news lands overnight. Futures price in optimism before cash markets open. If you only held the S&P during regular trading hours since 1993, you'd be roughly flat. Let that sink in. Now the monthly picture. Best month, November. Average plus 1.7%. Win rate around 70%. Tax loss reversal, year-end positioning, holiday optimism. Runners-up. April, plus 1.5%, and December, plus 1.4%. Earnings inflows and the Santa Claus drift. Worst month, September, average around minus 0.5%, the only month with a statistically significant negative bias since 1950. And the headline pattern that ties it all together, the sell in May spread. November through April has averaged about plus 7% on the S&P 500. May through October, about plus 2%. Same 6 months, same index, 3.5 times the return, for nearly a century. Now, the 4-year presidential cycle. This was popularized by Yale Hirsch in the Stock Trader's Almanac, and is one of the most consistent multi-year patterns ever documented in US equities. Going back to 1950s and the S&P 500. Year 1, average return plus 7%. New administration pushes painful policies first. Year 2, midterm year. Average plus 3 to plus 5%, but historically the year with the deepest drawdowns. The October low in midterm years has been one of the best buying opportunities of the entire cycle since the 1960s. Year 3, pre-election year, the standout year. Average return plus 12.8%, win rate above 80%. The political economic logic. Incumbents juice the economy. The Fed often leans dovish, and stimulus tends to flow ahead of re-election campaigns. Year 4, election year. Average plus 6%. Choppier and event-driven. The pattern that screams off the page, buy the midterm October low, sell into the pre-election year peak. Positive in roughly 17 out of the last 19 cycles since 1950. One honest caveat, the famous no-down pre-election year streak everybody quotes as a Dow stat. On the S&P 500, 2015 broke that streak at minus 0.7%. The pattern is strong, not infallible. Use it as bias, not as gospel. Patterns are interesting. Patterns plus one simple filter become a strategy. Here's the problem with raw seasonality. It gets crushed in bear markets. November 2008 was a disaster. April 2022 was a bloodbath. The calendar said buy, the market said no. The fix is one rule. Only follow the seasonal pattern when the market is already in an uptrend. And the easiest way to measure that is the 200-day moving average. Basically the average price of the last 200 trading days. If today's price is above that line, the trend is up. If it's below, the trend is down. That's it. So the full strategy is that simple. Buy the S&P 500 at the end of October, sell at the end of April. But only if the market is above its 200-day average. Otherwise, stay in cash. Backtested from 1990 to 2024, this simple rule captured roughly 85-90% of the market's gains with about half the pain. You sidestep 2008, you sidestep most of 2022, same upside, far smaller drawdowns. And you're only invested half the year. And here's the part that should make you sit up. Even Bitcoin follows a seasonal rhythm now. The 4-year halving cycle has lined up almost perfectly with US presidential pre-election years in every single cycle since 2012, 2013, 2017, 2021, and again in 2025. Same calendar, same crowd psychology, same liquidity wave. The asset class is new, the seasons are not. Honest disclaimer, seasonality is a tendency, not a law of physics. September 2024 was green. The pre-election year streak broke in 2015. Patterns get crowded, regimes shift, and anyone telling you the calendar is 100% reliable is selling you something. Use seasonality as context, stack it with trend, breadth, valuation, and macro. When 3 or 4 of those align, that's when you size up. When they disagree, you stay small or step aside. If this video gave you a new lens on the market, hit subscribe button. If you liked the video, then join Market Mind community in Discord. There, I'm giving more educational information, weekly and daily technical analysis of the market, and of course, free signals. See you there and good luck.